can you live off of investment income, solely investment income in retirement? And is it a bad thing to dip into our principal? Well, there are actually 3 additional questions that you need to ask and answer before you can really fully understand what your options are. So we're going to go through that today. This is Abe Abich, founder of Abich Financial Services, financial advisor. I'm Heather Branch here with Abe, asking him questions like these when it comes to your future and wanting to empower you with information about what your options are. Today, speaking specifically about investment income, Abe, because for so many of us, I mean, I don't want to say all savers, but when we get to retirement, for a lot of us, the investments that we have, that's what we have for retirement, what we've invested.
Sure.
So obviously this is a big deal for people.
Yeah.
And I think a lot of people wonder, can I live solely on the income that investment generates, those investments generate? In other words, not getting into the principal. So how do we figure that out? And also, I mean, is it a bad thing to dip into principal? I feel that's what we get taught, right? Don't touch your principal. But maybe it's okay in certain case scenarios.
Yeah. We just had a lady come in the other day with 10 million. 10 million. She doesn't think she has enough.
Come on.
She needs about $150,000 a year. Do the math.
Come on.
$150,000 a year. $10 million bucket of money. That's 1.5%. She could essentially throw that money in not a checking or savings, but like a low-paying CD.
Right.
And now it won't keep up with inflation, but you get the point. Right. She's got plenty of money. And that's what I found over my 23 years. Sometimes people coming in with the most amount of money, 10, 15, 20 million dollars, believe it or not, are just as concerned as somebody that has $1 million, $2 million, $3 million, or less than $1 million, that they don't have enough. They don't know. They don't know that $10, $15 million is a lot of money. It is for a lot of people. Yeah. But they don't know that. They don't know that. And they're just as scared that they're going to run out. So this is one of the hardest things for people to get and understand, Heather, because your entire working career in life, let's just say from 22 when you got out of college to 62, around that time, late 50s, early to mid 60s is when you're thinking about retiring. So for a solid 40 years, you have invested in the market, you've saved, you've been diligent, you've been prudent, you've been focused, you've been committed. You are probably taking on a good bit of risk, right, to get to your number. A lot of times most people come in to see us with typically millions saved, 2, 3, 4 million most of the time. Sometimes it's $1 million, $1.5 million. Sometimes it's less than $1 million, but not often. And sometimes it's $5 million or more. And they've been invested in companies that have done really well, especially if you look back at the last 5 or 10 years. I mean, look at the companies that are changing the world. Those are the companies that have done really, really well. The Mag 5, Mag 7, the Amazons, the Apples, the Microsofts, the Googles, the Teslas, the Nvidias of the world have just exploded. And because of that, people's life savings, for the most part, have exploded too. And the markets are at all-time highs, and their portfolios and their life savings are at all-time highs. So they knew how to grow it and save it and invest it and get to this point, but they have no clue, and they're scared or fearful of running out because they don't know how to generate income. And there's this switch that has to happen in their minds and in their planning that's going to help them get through that mental hurdle or mental block that I don't have enough, when most people do, most people that we see do. And it has to start with a change in retirement planning philosophy and strategy, going from that pure growth focus to growth and income, because having 80, 90, 95, close to 100% in stocks, which we see oftentimes, is not an income strategy. It's a growth strategy, right? Having all that money in growth-focused positions, stocks and equities, is probably not going to generate you the income that you need to generate. And sure, you could pull 3 or 4% out of a $10 million bucket of money, but when you have a lot of equities, you have a lot of stocks, you're taking a lot of risk, and those companies go down from time to time, which they do, right? Every couple of years, the markets are up, and typically you have a downturn. If you're in retirement, you have a downturn, and you're taking money out at the same time. That is a huge no-no, and something you really want to stay away from.
Okay.
So can someone live solely on investment income? They could They could if they have enough, right? It all depends. Like if you have, $5 million, 3% of $5 million is $150,000. That might do it for you. 4% is $200,000. That might do it for you. It might not do it for you. Well, then you're probably going to have Social Security. You may or may not have a pension, some rental income, and you'd probably be more than fine. But what if you only had $1 million? Taking 3 or 4% out, that's only $30,000 to $40,000 a year in income. You might say, well, Abe, I need $100,000. So can you live solely on investment income? No way. All right, if you're taking 40 grand out of $1 million life savings, you definitely need Social Security in there to really help you, and maybe some other income. So it all depends. And then in terms of getting into your principal, look, most people want to protect and preserve their principal, and they want it to be there in their 80s and 90s because most people will live that long. But and legacy is important for a lot of people. Passing on money to their loved ones, kids and grandkids and charities is important. It's usually not the most important thing for most people. The most important thing is typically taking care of themselves and enjoying the money while they're alive, especially in their go-go years, especially in the years where they're the most healthy and they're the most young and they're the most able to travel and able to get out there and go. And so in terms of getting into the principal, sometimes you might have to get into the principal, and there might be pieces of the portfolio you're okay with dipping into the principal. You may say, well, if I've got, I don't know, say $3 million and I spend $1 million of it on ourselves, and the million's gone, well, I'll still have the rest of the portfolio that's growing that could pass on, and I still have my house and my rental property or my beach property that can pass on and other assets. So it all really depends on what you want to accomplish. And then there are questions we need to ask ourselves at the point of retirement. Well, if we have the amount of money we need to pull the trigger and retire with dignity and confidence, then what is this new strategy going to look like? What are the instruments that I should be considering, or what are income-focused investments and strategies that I do need to probably implement in my plan to get away from pure stocks? Because this lady with $10 million, she was like 99, I'm not kidding, 99% stock. And believe it or not, the vast majority of that $10 million, I think it was 70%, is in 3 companies. Really? Yeah. Now, Apple and Microsoft, I think, were 2 of the 3. But still. And those companies will probably be around for a long time. But talk about a lot of risk. What if just something happened? I mean, what if the tech bubble explodes here? At some point, what goes up must come down. And if you're riding that wave up, you got to be prepared to ride the wave down. And I'm like, lady, you have $10 million. Mm-hmm. You need $150,000 of it. She has Social Security and other sources. She will never come close, probably, to touching any of that money. Right. She'd be able to pass a lot of money on as well. But with that, so she can enjoy this portfolio and life savings while she's alive, the strategies have to change, right? From 99% stocks to stocks and income-focused investments. So there are a handful of financial instruments that we would want to look at and consider that are income generating, income focused. And in no particular order, you can have dividend paying stocks, right? So we have dividend paying stock portfolios with companies like Home Depot, IBM, Exxon, Chevron, AT&T, Verizon. And, if you're getting 3 or 4% dividend, that's pretty good, right? Mm-hmm. With steady, reliable, strong companies as well. So you could be generating income from dividend-paying stocks. Now, if you have 99% of your money or the majority of it in growth-focused stocks, then the focus there is going to be the growth of that actual company and stock, not the income from it, not the dividend. So typically you have one or the other. Like you have stable, steady Eddie companies where the growth won't be as high as maybe an Apple or Amazon, but the income will be higher. And then you have the Apple and Amazons of the world where the dividend's lower and the growth potential is a lot higher. Annuities. Now, annuities can get a bad rap out there in the industry, but they are income vehicles. And the right type of annuity and the right types of annuities have been very good for our clients in creating a combination of that, growth and income, that balanced portfolio that people so so really need. And it could be a fixed rate annuity, it could be a fixed index annuity, it could come with guaranteed income, it might just be a bond alternative, maybe something principal protected where we have the potential to make 4, 5, 6%, something reasonable in the bond fund range, but without risk to our principal on the down, right? Where we eliminate sequence risk, where we can receive steady withdrawals in retirement that we can count on. That's not going to come with the volatility of the market. Structured notes. You can have growth-focused structured notes. You can have income-focused structured notes. And structured notes are with banks. Annuities are with insurance companies. But income-focused structured notes can help you to generate leveraged income. Like, if you look at a CD rate right now, as of the time of this recording, you could probably buy a 12-month CD at a lot of banks for around 4%. Well, in a leveraged structured note that's designed to help a client and retiree generate income, you might be able to make a gross 6 to 7% or somewhere in there. Now, you're going to be taking on additional risk. You can have risk to principal. You can lose money if the indexes in the note go below negative 20, but you've got a leverage return there. You have additional upside. If you're getting 5, 6% in income on a income-focused strategy, that's pretty attractive, right? Because what would you otherwise earn on bonds that can go down in value? Maybe the same return range, 3, 4, 5%. Moral of the story is, in addition to equity exposure, in addition to stock exposure and growth ETF exposure in the markets, we also need conservative instruments mixed in there to give us stability and to help us generate income. We're at retirement. Our income is going to end and stop from our employer. Yep. We're going to pull the trigger, retire. We didn't need income from our portfolio. Second question, do you have to resort to taking on higher risk to generate that income? Well, for most people we meet with across the DC metro area, that answer is no. And in fact, as an example, this lady, now she does have $10 million. Not everybody we see has $10 million.
Right.
But she's 99% stocks. And I told her the biggest takeaway from this first meeting when you leave here is that you have to and should really reduce risk by a good bit. I think the initial recommendation for her was to come down to an 80-20. 80% stocks, 20% fixed income.
Okay.
So do you have to resort to taking on higher risk to generate the income you need in retirement? For most people, the answer is no.
Okay.
For most people, they have saved enough to retire. Instead, they actually want to reduce risk by including, again, that combination of equities and fixed income. Would you have to save $1 or $2 million to safely pull the income you need? Well, for most people across the DC metro area, having $1 million to $2 million, most people that we see do, and a lot of people we see have more. And so I would say that number is going to depend on how much income that you need or want in retirement and what you want to accomplish. I mean, you could be someone that is single or married and retire with less than $1 million in investable assets. Well, what if you had $100,000 a year of pension and 1 or 2 Social Security checks, right? You might have, and we have clients that have $100,000, $120,000, $150,000 of guaranteed income without needing a penny from their portfolio. So that might be the case for you, and you might not need that number. Numbers are thrown out there all the time, like how much do you need to retire? And depending on who you're listening, for that advice from, and depending on who you're listening to, it might be $1 million, it might be $3 million, it might be $5 million, but it really all depends on who you are, how old you are, your risk tolerance, and what you want to accomplish in retirement. Yeah. So those are the main questions from this article, and hopefully that helps our listeners to start thinking. Especially if you have not retired yet, you're considering retiring here soon. You're taking on a lot of risk. You've done really well in the markets. You don't need to continue to take on a lot of risk, more than likely, to accomplish your objectives.
Just listening to you talk about just a couple of questions that we presented here, all it does to me is, I imagine you listening, watching this podcast, it just creates more questions, because that's the thing about getting to retirement. You've worked so hard, you've earned, you've saved, and the whole now what moment, I believe, is very real for so many of us. So Abe and his team, they are, of course, here to help you get some answers to the many, many questions you likely have. TheRetirementKey.com is our website and where to start the conversation. Also want to remind you about Abe's book, The Retirement Mountain, The 7 Steps to a Long-Lasting Retirement. Just a little over 100 pages. You could read it in a couple of hours, a quick afternoon read on a weekend to, again, empower you with information is the goal of Abe's podcast, his radio and TV programs. This book that he wrote just wants to give you information that he has acquired through helping folks almost 20 years now figure out retirement and empowering you with this knowledge. There's lots of ways for you to get a free copy of the book. Anybody who comes into the office for an appointment, you can also download the PDF version of it or listen to the audio version of it. That's available on Amazon. We have links to all of those things, again, in the show notes. Or, as always, just go to theretirementkey.com. And a bevy of information, it awaits for you there. Answers to the questions, Abe. That's all that we want. That's what you're helping us get.
That's right.
So
yeah, we help people every day, with these, needs and objectives, and they're getting close to retiring, and they need a plan, which includes income that they can enjoy. And that's really our specialty here at Abich Financial Services, is creating a phase 2 income and distribution focused plan that they can enjoy and live on, and help them, help those dollars last them the rest of their lives.
Abe and his team, they're here for you. If you've got questions, want to help you get some answers, visit us at theretirementkey.com.